All right, guys, let's start. Okay. Uh, we are doing chapter number, you know, not the chapter number, but we are doing your swaps chapter today. Very typical chapter, guys. Very difficult chapter, not easy to understand. We'll go quite slow here. So try to have an understanding. Okay, I have to build a certain kind of understanding. Then I will come to your, this part. Okay, so please understand that. Okay, so it's not easy, right? Let me build your understanding first of swaps. Let me write down few things in OneNote, guys. I'll send you that document PDF uh, in your WhatsApp group, so that won't be a problem, right? I have to write down few things to build your understanding. Once your understanding is built, then you will understand. That then it will not may take much time. But initially, it takes time unless you get the hang of what exactly is insurance. It's not easy to kind of figure out, right? So that's the whole point. I'm sharing a document, I'm sharing uh, another document with you. The only reason for doing that is because I want you to understand a bit before we go into the slides, right? The basic understanding I have to build. Okay, so we'll talk about swaps, guys. Swaps, right? So I hope you can see the OneNote now, right? Yeah, so you can see the OneNote. I'll write down few things. I write down here because it's easier to write down in the OneNote all those things. Okay, so basically we are doing swaps. The chapter name is your swaps, right? Swaps. Swaps is very similar to normal things in your life, right? When you travel in train, when you travel in bus, when you travel in even in the flights, right? There are people who come to you and say that, can you swap your seat with me? Can you swap, this thing with me, right? So swap is nothing but an exchange of one thing with the another, right? You are exchanging your seat with another person, right? You're exchanging your seat with another seat, right? So similarly, swaps is very similar. You are exchanging one thing for another, exchanging one thing for another, right? You're exchanging one thing for another, right? So swap is that. Now how does it apply to things in the financial world, right? How does it apply to things in the financial world? See, things in the financial world are also very similar. In financial world also, there is various kind of instruments which are swapped, right? So one of the very common instruments which is swapped is called your interest rate swap, right? Now you will always think, right, sir, why is somebody swapping an interest rate swap, right? What's the logic behind it? What's the interest behind it? See, please understand that, let's imagine that there are two people in the world, right? Mr. A and Mr. B. Now Mr. A thinks that the let's say we're talking about US markets. Mr. A thinks that the Fed has kept the rates high for a very long time, and I think the Fed will cut down the rate very soon. So Mr. A expectation is interest rate going down. Mr. B's expectation is exactly opposite. He's thinking that no, I don't think Fed will cut down because President Trump has recently passed the big bill, big beautiful bill, which kind of increases the fiscal spending in US. And when the fiscal spending goes higher, the bond market don't like it, and interest rate might go higher, right? So see here that two parties have different expectations, right? Different. Now imagine an additional layer of complexity that Mr. A has a you fixed rate of loan. He has taken a fixed rate of loan, and Mr. B has taken a floating rate of loan. Additional complexity I have added. So now what has happened is that Mr. B is worried about floating rate of loan, and he's saying today my loan rate is, let's say, 7%, right? And tomorrow the loan rate is, I am my analysis say that the interest rate will go up. So since that will go up, my loan will become higher, right? So tomorrow I will face a problem because loan might become 8%, 9% tomorrow, right? So I am not happy, right? I don't want it. Let me find a person. Let me swap my floating interest rate loan with a fixed rate loan, because he will say no, floating rate, because my future expectation is that the rate will go up now. So I am trying to find a way out of it. So he is looking for a person with a fixed rate loan. Similarly, this guy is saying, oh, I did a mistake, I took a fixed rate loan, I am expecting the rates to come down. So this guy is expecting the rate might come down to 6%, 5%. He's saying I'm locked up in 7%, right? I'm locked up in 7%. I want a floating rate, right? So see, B wants what A has, A wants what B has, right? Both parties are expecting different things. Both parties are expecting different things. And I think I have, I don't know, I have started the, oh, I have, thankfully I've started the recording. I was a little worried that I have not started the recording, but that's good, right? Otherwise I have to repeat again everything. So thankfully I've started, right? So that's a important thing we need to know, right? So what you can see here is that just because two people have different expectations, one is expecting the interest rate to come down, one is expecting the interest rate to go up. Now both parties don't want what they have already, they want different thing. Floating rate loan guy say think that the interest rate will go up, so he is looking for a fixed rate loan guy, and fixed rate loan guy is thinking rates will come down, he's looking for a floating rate guy. Now who will benefit at the end? I'm not sure, right? What will happen in the future? Nobody has any clue, right? Whether dates will be cut in July, Fed meeting in July, right, which looks very improbable because of some data, right? The data, jobs data was good, so the rate cut is not happening in your July, right? Whether the rate cut will happen in September, August, I have no clue, right? It depends on data, right? So what will happen in the future, nobody knows. But what is important to understand is that with these kind of different expectation is what leads to the origination of an interest rate swap. People with different expectations come together and try to swap their own position with some other's position. This kind of behavior is called swapping in the financial field, interest rate swap. Now, don't think that the world only consists of interest rate swap. There are many other instruments for swapping, right? I have given you the most popular one in the world. If I consider the universe of swap, right? If I consider the universe of swaps, right? In the universe of swaps, 70 to 80% of trading is done in your interest rate swaps, right? Interest rate swaps, right? Then around 10% is done in your FX swap, currency swaps, right? And then 5% is done in your what you say credit default swaps, right? So if I take 80% interest rate swap, 10% FX, 5% CDS, right? And rest of them volatility swap, variance swap. There are many other swaps also. Volatility swap, variance swaps, etc. Those consist of also 5%, right? So rest all consist of 5%, but major categories of swaps in the world is your interest rate swaps. This is the major category of swaps. Rest are also traded in the world, but our focus will be mostly on your interest rate swaps, right? That will be our major focus in this chapter. Okay, so keep that thing in mind when we are studying. Interest rate swap is a very, very important part of your syllabus. Okay, so all right, let's move ahead now. Go back to presentation, right? So this understanding I wanted to build, that please understand that swapping is very common. Swapping is done for benefit in different condition, different scenarios. People with different swaps have different expectation. One party might be expecting interest rate to go up, other party might be expecting interest rate to come down. Depending on the scenario, depending on the circumstances, it depends that what one party does. So that's another scenario. So keep that in mind, right? And you never know what will happen in future, which party will be in profit and which party will be in loss. I have no clue, right? I have no clue, right? And nobody has any clue on that, right? So now let's go back to presentation with this understanding. Okay, let's start your swap, right? Okay, so we'll try to understand the mechanics of interest rate swap. We'll try to understand the valuation of interest rate swap, and we'll look at the other types of swaps also, right? So, like these are the mechanics and the cash flow we'll discuss, and how to transform an asset liability for financial intermediaries and comparative advantage, right? Okay, let's go here now. Let's get into the detail, right? So basically the same thing which I discussed till now, right? Basically in your swap, what you are doing is there is an exchange of fixed versus floating interest rate payment on the notional principal. Why did you exchange it? You exchange it because you had different expectation of the interest rate. One was expecting interest rate to go down, so he was saying that, oh, if I'm stuck in fixed, let me go to floating. One is expecting interest rate to rise, and he say, oh, my floating will increase, let me go to fixed. So you are exchanging fixed and floating interest rate payments on your notional principal, whatever is the notional principal you agreed. Payments are generally in the same currencies, net amounts are exchanged. It's not that you give the full amount. You say that, okay, we'll calculate the value. One part is in profit, one part is in loss, right? What is the net value? You exchange it, right? So net amount is exchanged, not the total amount. Floating leg usually tied to SOFR. Earlier it was tied to LIBOR. SOFR is the benchmark in the industry. We have already covered in the interest rate chapter. SOFR is the secured overnight funding rate, which is the benchmark we use in the industry, right? So keep that thing in mind, right? LIBOR was the other benchmark, which is not used now, right? So what you are saying is that, see, the example here is, it might be the fixed pays 3.784, LIBOR pays SOFR, and then they will explain. And normally the cash flows are semi-annual, right? So this is the different cash flow they are given, that, okay, first period the cash flow might be this, second period the cash flow might be this. So SOFR might change, right? Because SOFR is not fixed, right? One is a fixed cash payer, right? Another is depending on the floating rate. And floating rate, since it is tied to SOFR, it changes with the time, right? If it is 3%, what do you do? 3% into your 1.5 million, right? So you see that, right? That this is my calculation. So how did we get this value? How did we get this value? Please understand, it is very easy calculation, right? What do we do, right? You have, see, you are saying you take 1.5 million, right? Unit 100, yeah, 6060, right? 1.5 million, you multiplied by your 3.784%, right? You calculated something, and you also multiplied your 1.5 million, right, into your 3%, right? Both cases. And then you took the difference, right? You took the difference, you calculated the difference, right? And you found out that, right? Difference you took, right? Difference you took. Please understand, please pay attention to this, periods also, right? These periods are very important, because these are your periods for, what you have, these are your periods for your 6 month, right? So if 6 month is the period, then you have to multiply it by 0.5 also, that it is half year, right? 0.5 also, right? So value will come out if you multiply the above things. And right, sorry, this is not 1.5 million, guys. Sorry, this is not 1.5 million. This 1.5 million is floating cash flow. So I kind of missed out on that. This is not 1.5 million. Let me kind of go back. This will clear it. Okay, fine. Let me write it again. Basically, this is floating cash flow. This is fixed cash flow. Okay. The point here is that floating cash flow is changing because floating rate is changing, right? Then fixed cash flow is fixed. How did I get fixed cash flow? The principal amount here is 100 million. The principal amount here is 100 million. If I have to calculate for the floating part, it will be your 100 million, right, into your 0.03, right, which is this 3%, into your 6 month 0.5. This comes out to be your 1.5 million. This is your 1.5 million. Right. Next month, if I have to calculate again, I multiply it by 3.50, 0.0350, right? How did I get the fixed one? Fixed one, I got it, your 100 million multiplied by your this amount, 0.37, 0.03784, multiplied by your 0.5. Then I got your 1.1892 million, right, which is this. So ultimately you subtract it. Floating minus fixed is this. Floating minus fixed is this. Fixed, floating minus fixed is this. Floating minus fixed is. So two values are negative, two values are positive, right? Ultimately, the logic is same. Only thing was the principal amount I had taken wrong. Principal amount is 100 million in both cases, right? Then you are multiplying with your fixed rate, right? Floating rate in one case, fixed rate in another case. Ultimately, you are multiplying by 0.5 also because it's a semi-annual cash flow. You don't want to have full year, period is half, right? That you are calculating, and then you are seeing the net cash flow, right? You are trying to find out. Okay, so that's what you do. Okay, very simple kind of thing. Next one. Next one is how do you transform an asset liability using interest rate swap, right? That's the beauty, right? Which I taught you in the OneNote, right? Basically, when one guy who is kind of looking to go to the other side, right? So if you are let's say you are Mr. A and B, right? Suppose that your Mr. A has a 2-year kind of floating rate liability, right? Mr. A, suppose that there
Sir,
is Mr. A. Go on.
yeah, we will always do floating minus fixed and not fixed minus floating every time.
And no, it's not necessary.
Hmm.
Basically, if you go back, right? If you go back, it's not floating minus. See, in this example, I had taken that, I have not given full things, but in this example, we are trying to calculate the cash flow, right? So we are saying that, okay, there are two parties, one is on floating, one is on fixed, right? And cash flow is exchanged, right? So now what I am saying is we have to see what one is paying, right? And what other is paying, right? So when you have to find the net, right? Net thing can be found out whatever. You can do fixed minus floating also. You can do floating minus fixed also, right? You can do any ways. But if they tell you that okay, you are, let's say, fixed pair, right? Then you have to
Hmm.
take a fixed, like if your position is fixed, you are fixed player, then you take it okay from your side that okay, I am paying that is negative, I am getting that is positive, right? So that way will
Okay.
work like this. Then it will be what you are receiving, that will be positive, what you are paying, that will be negative, right? But if
Okay.
nothing is given, you take whatever net thing. Make
So
sense?
in this case, yeah, it makes sense. But in this case, we are calculating from the floating perspective, right?
Yeah, so we are calculating that okay, floating cash flow was this much, fixed was this, so we are saying that we are a fixed pair, right? We are
Fixed
saying a
pair
fixed,
and receiving floating.
yeah,
Okay.
right, receiving floating.
That's why it's floating minus fixed. Either if it's the other way around, then it would be fixed minus floating.
Yeah, either way or fixed minus floating. So whatever you
Hmm.
are whatever you are receiving, that will be positive. Whatever
Correct.
you are paying, that will be
Paying
negative.
that would be negative. Yes.
Right,
Got
that
it.
will be negative, right? Now we are talking about your conversion of liabilities, right, using interest rate swap, right? I've in fact covered that in your initial discussion when I talked about things in the OneNote, that eventually what you are doing is you are in floating, you try to move to fix, you were at fix, you try to move to floating, right? So that example, same example is here. I'll take with another thing which you are given in your book, right? Suppose that there is okay, there is Mr. A, right? Mr. A has your let's talk about Mr. A. Mr. A has your 2-year your floating rate, floating rate liability. Okay, it's a liability, means he has to pay, right? And Mr. B has 2-year fixed rate liability. Right. Now, both parties have different liabilities. After they enter into your swap agreement, right, interest rate exposure from their liabilities have completely changed because now they have entered into agreement with one another. So now, once you enter into agreement in a swap transaction like this and like this, So A liability, which was your floating earlier, has become your liability, right, into a fixed rate liability. B liability, which was a fixed rate liability, has become a floating rate liability, right? So exactly opposite. So if you are floating to fix, you pay fixed and receive floating. If you are fixed to floating, right, you are paying floating and receiving fixed, right? So please understand that liability transformation will happen, right? And even sometimes in this another consideration, which is your asset transformation also. That's assume that if there is A that has a fixed rate asset, right? Let's say if you have A, you have fixed rate asset, right? And you have B, you have floating rate asset, right? Both have different kind of asset, guys. Fixed rate asset, floating rate asset. When they enter into a kind of a swap transaction, right? After entering into the swap transaction, right? The swap kind of modifies their, you know, exposures, right? Now, since you have entered the swap, the fixed rate asset has been changed into a floating rate asset, because again fixed is demanding floating, and floating has changed into fixed, right? So swap is a very good instrument. By if two parties enter into it, they can change their what you say, their exposures. One can be your liability transformation, one can be your asset transformation, whatever you want, right? When you enter into a interest rate swap, you are able to transform your liabilities, right? Yeah, and that's what I talked about in earlier in the first 10 minutes or so. We talked about that when your expectations are different, right? When one party is expecting that market will move down, interest rate will move down. One party is expecting interest rate will move up. If you are, let's say, uh, you know, a party which is worried about, like you are holding a floating rate bond and you are expecting the market to go up, you will try to move to fixed rate exposure, and that you can do by entering into a swap. Similarly, the fixed rate guy is expecting market to move down and he wants to move to floating. He can move from floating exposure to fixed exposure by moving into getting into a swap, right? Now who will win in the future, nobody knows, right? But this is used very effectively in the risk management world, so remember that. Okay, all right, next one. Okay, all right, next is, which of the following swaps would properly transform a floating rate liability to a fixed rate liability, guys, right? Think about it, right? Tell me now, anybody can make a guess. Which of the following swaps, which of the following swaps would transform a floating rate liability into a fixed rate liability? Any idea, guys? What do you think?
Second one, pay fixed IRS,
Why?
See,
because you want to transform your floating into fixed, right?
Hmm.
So obviously you will start paying fixed and you will receive uh,
Okay.
no,
Think
entering into
about
the
it.
floating, transform of floating. Yeah, that's right, no? Into a fixed rate liability. But then,
Okay.
but then
Anybody
you would
else?
be receiving floating. Mhm.
Anybody else want to take a shot?
option C, that is entering into the paying domestic currency swaps. So IRS is basically, as you mentioned earlier, it can be swaps in same currency only.
Hmm. No, see, I don't think we need to go to currency here, like to be sure. See, currency we have not even taught, so I'll not touch upon that. See, the point here is the answer which Anil gave is perfectly right. See, logic here is, see, objective is that you're moving from floating to fixed, right? If I see, you have exposure to floating to fixed, right? So what is your liability, right? You have floating rate liability, right? So it means you have a floating rate loan. Your floating rate loan, right? Let's say you are B, and you you have a floating rate loan, right? Floating rate loan. If you have a floating rate loan, right, you are worried about market going up, right? You're worried about interest rate going up. You get into a kind of swap with A, right? And what you will try to, you enter into a, basically you have a, your liability was pay floating, right? Pay floating, right? You wanted to pay. Now you don't want to pay floating, right? You want to get into fixed rate liability. You want to get into pay fixed, right? So pay fixed interest rate swap, right? You want to pay fixed. So what you are doing is you are entering from a floating to pay fixed, right? Which is B, right? Entering. It's a very simple, like not a difficult question. Like don't, like I get your point. You're trying to think on little ahead, but it's not difficult, right? Basically, it's a very simple concept. You are paying floating. Now you want to move to pay fixed, right? So you enter into a fixed rate interest rate swap, right? Just understand the question, okay? Very simple, right? B is the answer. Yeah, B is the answer. Okay. Now the next part is financial intermediaries, right? When I talk about financial intermediaries, right, what we need to understand in this part of the lecture, right, is that how does financial intermediaries, uh, what you say, play a very vital role, right? How does financial intermediaries play a very vital role in your swap market, right? That's the first point we need to understand very properly, right? Obviously, when financial intermediaries kind of act in the swap market, they are acting as your market maker or principals. When I say market maker or principal, so now what we need, what I was telling you was that in the market, what we need to understand very clearly that there are financial intermediaries which act as your market maker or principals, right? Why? Because we have asymmetry of needs. When I say we have different corporation, corporate A kind of you know wants to get fixed rate exposure. There is a bank there which wants a floating rate exposure, right? So those exact desires seldom kind of line up perfectly, right? So intermediaries which exist in the market bridge those gaps, matching your buyers and your sellers of risk. There is a credit and liquidity provisions. They stand ready to trade when natural counterparties are not available. By warehousing positions, they absorb your mismatches in your timing or size, right? So financial intermediaries do lot of work, right? So common intermediaries are your banks, dealer, brokers, right? They match counterparties in your swap, right? If you think about your business model, what exactly to do, they are, they are market makers. Means market makers means they quote two-way prices, your bid price, your ask price in swaps, and kind of commit to trade at those prices. They guarantee liquidity, tight quotes if volumes are high. Another is your principals, right? Principals means they take the other side of the client trade, right? And then hedges, possibly with another dealer or in the market, right? So counterparty is the kind of bank, uh, you know simplicity of dealing is there. If there are hedging, your there are cost and risk, uh, which are imperfect here, so that also need to keep in mind, right? So typical intermediaries, you think of banks means JP Morgan, Citibank. These have your balance sheet capacity to kind of warehouse your large notional amounts, extensive credit lines with corporate and other dealers. When you talk about dealers, these are specialized trading houses. These often kind of spin out of banks or hedge funds, linear operations, focus on your particular asset class. Brokers, you know that your brokers are many in India, also abroad also. They do not take your principal risk, means they do not take the opposite party, opposite side in the client trade. They don't do that, right? But they match buyers and seller anonymously or on platform and earn commission on your each trade, right? If you talk about matching counterparties in swaps, that work is done by dealers, right? How to match counterparties in swap, right? There might be a client request that they want to match. Company X wants to, let's say, pay fixed 3% on your 100 million 5-year swap, right? So dealer will quote, pay fixed 3.0%, receive floating. So once you have done that, a dealer, let's say, has an offsetting floating receipt in his book. It can take the trade outrightly, right? No hedging. If there is no offsetting trade, right? If no natural offset is there, dealer A will have to tie up with dealer B, right? Pay float, receive fixed, and then kind of run this trade, right? So there is a money commission earned on the every such kind of trade which the dealer gets, right? That definitely create an operational risk in such kind of scenarios. Your When you talk about credit lines and your credit support annexure CSA of the your ISDA master agreement, right? International settlements of your derivative association. Basically there is credit support annexure of the ISDA master agreement, which dictates your collateral posting thresholds, your haircuts, your eligible collateral. There is netting, which we have talked about. All transaction under one ISDA master can be legally netted to a single net exposure and default. Then there is a MTM and variation margin, which we'll keep in mind. So ISDA kind of confirms all things, right? There is a master agreement, there is a schedule, there is a CSA, trade confirmation happens, right? And in case there is a default, there is early termination, replacement cost, and closing amount, right? So as a financial risk manager, or a FRM student, please understand that if there's an intermediation or intermediary, that doesn't mean that's a zero risk, right? Dealers earn spread, but incur your market risk, incur your credit risk, incur your operational risk. Documentation is very central. That's why we have ISDA master plus CSA plus confirmation, which acts as a legal backbone. And risk management layer, you have netting, collateral, daily MTM, legal closeout, all work together to contain your exposures, right? So just a generic kind of thing. I don't think anything will come from here, but just to give you a generic idea, right? Next part is comparative advantage. Now this is very interesting, right? This is very, very interesting, guys. What is a comparative advantage? And in swap, who has the comparative advantage and why, right? Why would somebody have the comparative advantage? What will it lead to, right? And how we can use in your in the real world, right? How we can kind of use this in the real world, right? So basically, when you look at the concept of comparative advantage, there is a absolute versus your comparative advantage, right? Absolute advantage means what? Means one borrower can raise funds more cheaply in both your fixed and floating market, right? We're not talking about that. We're not talking about absolute advantage, guys. We are talking about your comparative advantage. Now, what is comparative advantage? Comparative advantage exists if the spread between your fixed and floating, right? Fixed and floating funding cost is relatively more favorable for one buyer than another. See the difference. I'm not talking about absolute advantage. I'm talking about comparative advantage. And when I'm talking about comparative advantage, what I'm saying is that if the spread between your fixed and floating funding cost is relatively more favorable, right? More favorable. Let me write it down. Please understand. Comparative advantage is that your if your spread, right? If spread, right? If spread between your fixed and floating, right, is comparatively or is relatively, right, or is relatively more favorable for one borrower than another. Again, I'm telling you, it's not about absolute advantage, it's about relative advantage, right? Why we need to study this, why it matters? Because even if one party is cheaper overall, both can share the extra savings that a swap makes possible versus borrowing directly, right? So that is the logic here. Even if one party is cheaper overall, right? That extra benefit can be shared, and then that's why swap market becomes better than, borrowing directly, right? Now, how both firms can win, right? That's why we given shared savings, right? Both firms are winning, right? So basically, if you have a, let's say, direct borrowing cost, right? If you have a direct borrowing cost, right? So a firm will borrow at, what you say, a certain percentage, right? So 6%, let's say, right? Then other firm is doing at your 4.5%, right? See, let me write it down. That will give you more idea, right? Basically, you take the firm, let's say X firm, right? What is the floating cost for the X firm? Floating cost for the S firm is your SOFR plus 1%. This is your floating, right? Now, your fixed cost for that firm is 6%, right? Now, when I see what is the difference, right? Then I get what? The difference is 6% minus 1%, right? So difference is 5%. Fixed minus floating differential, if I take fixed minus right, so I get 5%. Okay. In the other case, in the Y case, again SOFR plus your 0.1%, right? It is 4.5%, right? And 4.40%, right? So 4.5%, right? And your minus zero point 0.1, it becomes 4.40, right? So what we are seeing is that fixed minus floating differential here is 5%, fixed minus floating differential here is 4.4%, right? So comparative advantage, if we see for X, right? If I see for X, your X's comparative advantage is 5%. Your Y's, your differential is 4.4%. So what we see is that X has larger gap of your 60 basis point, means 0.6 percent, right? X has larger gap of 0.6%, right? This 60 basis point or 0.6% represents the maximum shared savings if they kind of swap, right? Now, if you're trying to structure this kind of swap, you can always structure this kind of swap that X will borrow at the floating rate, Y will borrow at the fixed rate, right? Enter into a swap kind of agreement where X agrees to pay. Okay, let me write it down because I don't think this is given. Let me make it easier for you. Okay, the numerical is given. So what I'll do is let me make a slide here, right? That will add value, right? So what I'm trying to say that somebody thinks that, okay, sir, how will we structure the swap, right? If I have to structure the swap, right, what will my first step? What you do, I'll say X borrows floating, right, which is your SOFR plus 1%, right? Then Y borrows fixed, right, which is your 4.5%, right? So basically each is, right, what is the logic going behind it, why I'm doing this kind of thing? Each each issues, right, in their cheaper markets, right? Each issues in their cheaper market, right? All right, what is the step 2? Step 2 is enter into a plain vanilla swap, right? So X agrees to pay, right, fixed to Y, right, at rate R, let's say at R, and receive floating, which is SOFR. Y agrees to pay floating SOFR to X, right? Receive fixed, right, at R, right? What is happening in step 3 now, right? Step 3 is that you choosing R, the fixed rate, to share their savings. Again, this is not given in a book, guys. This is just for explanation, right? The logical explanation that how they are saving it, right? So the total differential was this. I'm explaining extra so that this sticks to your head. What I total differential was your 60 bips, right, which is 0.6%. Let's say they split evenly. I'm assuming split evenly, right? So so they pick R halfway between excess fixed cost, which is 6%, and Y's fixed cost, which is 4.5%. Right. So what you will do is R is equal to 4.50 plus 60 bips divided by 2. Right. 60 bips divided by 2. So it will be 4.80. Again, this is not explained in your book too well, right? So I'm told you that when you talk about shared savings, comparative advantage, this is how they will use comparative advantage, right? First, they will, borrow in their cheaper markets, right? In both cases, if you go back and see, right, they borrowed in their cheaper market, right? They borrowed in their cheaper market. One was, the cheaper market was SOFR plus 1%, other was 4.5%. So they borrowed in the cheaper market. Once they borrowed in the cheaper market, they enter into a plain vanilla swap. They kept the uh, fixed rate at R, receive fixed rate, then try to find out how to save that fixed rate, what was the differential saving, and then they kind of divide it and adjusted it, right? So very, very logical in nature to understand, right? If you have any question, you can ask. Okay. Moving on. Moving on to the next part, guys. Right. Very important. Let's do this numerical. Okay. Let's do this numerical. When we try to understand this numerical, guys, right? What is important? Please read it carefully. Right. There are two companies, right? C and D have the borrowing rate shown in the following tables, right? If these borrowing rates are shown in your following table, C, the fixed borrowing is 10%, SOFR is 50 bips, D, 12%, SOFR is 100 bips. Again, the logic will be you borrow in your cheaper currencies, right? That is how you do, right? Then you kind of see what is the uh, you know uh, the earning potential, right? So what you see here is, right, what you see here is that you try to find out what is the earning potential, right? Let me solve this question, guys. What is happening here is that what you do, you write down each firm's floating versus fixed spread. My first step is, you find out the spread,
Question. Oh, okay.
right? You find out the spread. First spread is your fixed rate minus your floating, right? Your floating, okay, floating borrowing, right? When I try to do that, so this is 10% and SOFR plus 50 bips. So 10% minus 50 bips, guys. Don't take SOFR. 10% minus 50 bips. So this came out as 9.50 bips, 9.50%. And then below one came out 12 minus 111. Right. So next step is, compute the total savings. Right. Compute the total potential savings. Right. So it's very simple, right? Your total saving 11% you got in the D scenario, 9.5% you got in the C scenario. So saving is 1.5%. That's it, guys. What is the total potential savings if they enter into interest rate swap? See, very easy question if you understand it logically. If you understand it logically, it's so simple. So simple, right? You don't have to remember anything. You got it, guys? How I solved it? Everyone?
Yes.
Right? Very, very simple, right? Just remember it, right? So that's why I'm saying this chapter looks difficult, but if your logics are at place, you will do very well.
Yeah.
Right? And that, yeah, go on. And that's why I gave you this example also, right? This is not given in your book, guys. This is like I have created this example just for teaching. This is not given in the book, but what happens is that it gives you a very clear idea, right? You'll never get confused, right? What to do, what not to do, right? So it become a very easier thing, right? To solve the question. Okay, so this is done.
Yeah.
Okay,
One question. If you go back to the
this one.
yeah. I understood the logic, everything is fine. But if you look at the picture, C has competitive advantage in both the market as compared to D.
C has why you're saying that?
Because even if you look at D is paying SOFR plus 100, and anyways the fixed rate is 12%. So C is borrowing at 10% and the floating is again SOFR plus 50 bips point. So if we'll see, anyways, C is getting less rates, even if he goes to either of the either of the market.
See, I think you are confusing your, since you are saying that in this case, C has advantages in both market. You are saying C has advantages in the fixed borrowing market also, and C has advantage in the floating borrowing market, right? And is that really true or not, right? See, the point which you need to understand in this whole thing is, right? Please understand that when we try to take the absolute advantage, right? C has definitely an absolute advantage because C is the cheaper borrower in both market, right? That C has absolute advantage in each market, but that is absolute. The question is about comparative, right? Comparative advantage isn't about who is absolutely cheapest, right? Comparative advantage is a different funda, right? It's about who gives up less by doing one thing instead of the other, right? So it is comparative advantage is more about your opportunity cost, right? So comparative advantage is, you are right in saying that C is advantage in both market. I am not disputing that, right? But that is a absolute advantage concept, right? So absolute, we are not studying absolute advantage, right? Please understand. Absolute advantage and comparative advantage are totally different. You are touching upon right now absolute advantage. Absolute advantage is not equal to comparative advantage. Now, what exactly is your comparative advantage? The comparative advantage is more like that who gives up less by doing one thing instead of the other, right? So opportunity cost, it is more like an opportunity cost kind of concept. Comparative advantage is opportunity cost, right? So what is happening here is when you look at this, right? uh, if you look at C, right? C has the uh, in the first case, right? If you look at SOFR plus 50 bips, C has 9.5, and then SOFR plus 1 and your 100 bips or 12, C has 11%. If you stop here, it looks like C has the lower opportunity cost in both, right? But if you try to do a comparative advantage, right? Uh, that doesn't happen, right? Because ultimately that is a not you are looking at the party with the larger absolute advantage, which is C, 2% in the fix versus its 0.5% in the floating, uh, should specialize in the market where its advantage is biggest, right? So the point here is that how much advantage you are getting bigger in the, so if I go, see, C has how much advantage in the fixed, how much advantage here? 2%. How much advantage here? 0.5%. Now the question comes is, where should C go? So C should go where it has higher advantage, where the advantage is bigger. So C should go to fixed, right? And other party naturally takes on the other role, which is floating. You're getting my point? Because C is going to its comparative advantage, which is 2%, right? So other party is staying floating, right? Why it makes sense for D to issue floating, right? So issue fixed here, right? Cheaper thing, issue fixed. Why it makes sense for D to issue floating is because although D is more expensive on both fronts, right? Its penalty for borrowing your floating is only kind of 1% versus C's 0.50 fixed, right? So it is kind of less bad related to a fixed penalty of 2. So here D is saying that I am suffering 2% here because C is having 2% advantage. So D is suffering -2 here. Here, here, here the D is saying that I am suffering only 0.5%, right? So he is also saying now that okay, let me suffer less, right? So D want to suffer less, right? C wants to gain more. So it's a win-win thing for both parties, na? Right?
But
So keep that.
question: can we say that here that D has the comparative advantage in the fixed market and C at the comparative advantage in the floating market, and the end D at the absolute comparative advantage? Does it make sense?
So C has a comparative advantage in the fixed, right? Because there is a two,
Yes.
right? C has a comparative advantage in fixed, right?
Okay.
So it
Yes.
should stay because 2% and 0.5%, it is getting more gain here, 2%. So C
Exactly.
has more advantage in fixed. So
Exactly.
C should stay in the fixed. And
Exactly.
that's why issue fixed. D has comparative advantage in floating. So D
Exactly.
should go to floating. Make sense?
Exactly. Makes
Okay.
sense.
Okay.
Makes.
Right. So yeah. So what I'm trying to say that You are looking for comparative advantage, not the other thing. Okay. All right. Next one, guys. Now we are trying to value the interest rate swap. You have to use discount rate, value an interest rate swap with two bond position, and value the interest rate with your FRAs, right? Forward rate agreements, right? We'll try to do it, right? So let's how many slides we have? Should we take a break and then do it? Because this numerical will take time. Currency swaps is also we have lengthy chapter. Last part is not so important. Last part is easy. That is easy, but yes, there are 2-3 numericals here which will problem. So what we'll do, let's cover the theory part, and then when we start numerical, we can take a break and come back again and do it. Okay. So all right, let's talk about this now, guys. Let's talk about the discount rates, right? Let's talk about discount rates, right? First, understand the discount rates. What exactly is happening here? Why do we need to understand this part? Very, very important, right? See, when we talk about discount rates, especially in your FRAs, right? Especially in your swaps, right? When you talk about discount rates, especially in your swap, you have to understand that in swaps you have your swap value, right? When you have a swap value is calculated by present value of the future cash flows, right? And when you try to calculate something with the present value of future cash flow, you already know that you have to discount it, right? So basically, what are we discounting? In interest rate swap, it's simply an exchange of two sets of your future cash flow. You have a floating leg, right? Floating leg, please understand, is periodically resetting payments based on your SOFR or any other reference rate, which can be LIBOR, etc. also. So that is the thing given to you. Fixed leg is level payments at a pre-agreed fixed rate, right? Now, when I have to find the swap value, right? When I have to find the swap value, what I have to do, right? So that's what we'll try to do. What I have to do, right? When I have to calculate the swap value, right? When I have to calculate the swap value, I have to take the present value of your floating leg, right, minus your present value of your fixed leg, right? Now the question comes is, why use your spot rates? Why use spot rates, right? See, spot rate is the annualized zero coupon yield for maturity, right? So let's say if you have received a cash flow of 1 at some time at t, right, you can always discount it and find out the value today, right? Now, what do you mean by the SOFR curve, right? SOFR curve. See, when you are trying to build the SOFR spot rate curve, there are obviously some market inputs, right? So what are the market inputs here? You have, when you're trying to build, your the SOFR of SOFR spot curve. So what do? You use your overnight index swaps, right? Which we have already discussed OIS rate in your first interest rate topic, right? So overnight index swaps on your SOFR, right, give your par OIS rates, right, at your various maturities. Okay. Now you can use either euro dollar futures, either you can use your SOFR futures, right? Euro dollar was a concept which was explained very well in your some topics, but this year onwards, euro dollar has been removed from your syllabus, right? 2025 till 2024, euro dollar was part of your syllabus. So now they only mention it little bit, but I'm not going deeper in euro dollar, because euro dollar used to be a very deep concept until last year, but this year it is removed. Euro dollar SOFR futures can also be used can also be used to infer, right? To infer your short term, your forward rates. Okay. Ultimately, you start at the shortest maturity, you do the bootstrapping, you use the forward rate versus spot rate relationship also. That can also be used. Keep that in mind. What is the forward rate relationship which is used for discounting? I'll give you a relationship between your forward rate and your spot rate. The relationship is 1 plus R, right? R2 is given as your, let's say, T2 is equal to 1 plus R1 T1 1 plus F okay. So this is what you have, right? This is the relationship for the forward, guys, forward rate relationship. Even though it's not so useful for the numerical purpose, but you should know that if I have to find the formula for the you know, there are two time periods, right? So basically what is happening is that if I take time period such as your, this is one time period, right? It is the, this is first time period, this is second time period. First time period as your R1, second time period has R2, right? We are trying to find out what is the relationship, right? And this is your F, your 1 2, FT1 T2, right? F12, right? So F12 is the rate here, this rate. R1 is the rate, this rate. R2 is the rate, this rate, right? So we are trying to find out the relationship which we have, and ultimately we compute the each leg's present value, and we're trying to get the present value of floating minus present value of fixed. That is your value of a swap. Please understand that you should always use discount rate with zero coupon spot rates, right? You should always use with zero coupon spot rate. Bootstrapping is how you build your OIS, SOFR, spot rate curve from market instrument. Bootstrapping we have discussed in the chapter your interest rates, right? Forward rate determines your floating cash flows. Spot rate determines your discount factors. The difference between the present value of two legs gives us the mark to market value of the current swap, right? So we have seen this. I think that is enough for right now, because ultimate knowledge will come in your, when you solve the question. Okay. All right, guys. So what we can do right now, it's almost 8:20. What we can do is, guys, we can take 10 minutes break, right, and come back and then start ahead, because we'll do some tough numericals. So it will go for 1 hour more class, 1.5 hour. So we can take a quick break of 10 minutes, and then we come back and solve these some harder numericals, right? So you can have some tea, coffee, dinner, whatever, and then we start ahead again. All right. Thank you. All right, guys, let's start. Okay. So now what we'll do is that we'll try to do the calculation, valuation of an interest rate swap with two bond position, right? It's mostly for explaining part, guys. You are replicating a swap with your bonds. You are replicating a swap with bonds, right? So what I'll do is, again, I will go to OneNote. I'll write, because there's a lot to write. So let's go to OneNote and write there, because it is easier to write there, and then we can come here, right? So okay, I hope everybody can see this. Right. Yeah. Okay. So let me give you the idea what is happening. Then we'll go back to the slide and see there, guys. This is more for understanding part. I have to build your understanding, right? So we are trying to do what? You are trying to replicate, right? You are trying to replicate a swap, right? This is tedious, guys. 2-3 concepts are tedious, so that's why we took a break also. That We come back fresh and read it, right? So we are talking about now replicating a swap with bonds. Replicating a swap with bonds. Okay. So what is the swap position we will take, right? Please understand. When I'm trying to replicate a swap with bonds, see, swap position was what? Pay floating, right? Pay floating and receive your fixed, right? Receive your fixed. Right? So basically it means that you are paying SOFR, which is the floating rate, and you get the fixed, right? You get the fixed. Now, how do I replicate this, right? If I have to make the equivalent bond position, right? Equivalent bond position. How do I make it? If I have to make an equivalent bond position, guys, what will I then do is that I will go long, right? Go long a floating rate note, which is your FRN. All right. So you receive your SOFR coupon, right? And then you short, right, a fixed rate bond, right? When you short a fixed rate bond, you pay the fixed coupon. Please understand. See, ultimately, you are making the position which is equivalent to the swap position. Swap, you are paying your floating now, right? So what you are doing, you are, if I have to pay floating and receive fixed, right? I have to pay floating and receive fixed, right? So what do? You are long a floating rate coupon and you're short a fixed rate bond, right? Now, when you go long the FRN, listen to me carefully. When you go long FRN, right? When you are going long FRN, right? You hold a security, right? Whose coupon resets each period, okay, to the prevailing SOFR, right, plus any spread, right, whatever spread you can have, right, plus any spread. Okay, when you are going your short fixed, right, you have issued, right, that is issued means you are short a standard your fixed coupon bond, okay, paying the swaps your fixed rate, okay. So by combining these two positions of long fixed rate note and short your fixed coupon bond, you receive, right, what you are doing. So combined position, if you have, now you have a combined position, combining these two positions which I talked about above, right, what am I getting, right? You have kind of created the exactly the same cash flow of the swap, right? So basically you now receive the floating from the FRN, which offsets the floating leg of swap and you pay fixed, okay, on the short bond, okay, which exactly matches the fixed leg you have entered on the swap. So basically it's a replication, right? It's a replication. Now the question comes is that, okay, sir, I have created a long floating rate note and a short fixed rate bond. Now I'm using that to create the same payoff which we have from the your swap, right? Now how do I value such thing, right? How do I value? If I have to value of each leg, right? Value each leg, right? So one is the value of your FRM, right? So what happens at every reset date, a par FRN note, one that pays exactly the reference rate, you know that should always trade at par value, right? It's always equal to the notional value. Now between reset date, you may have accrued but unpaid interest, but more generally you discount each floating leg cash flow, right? You discount each floating leg cash flow, right? Uh, which is also known as your forwards, right? At the OIS spot curve to get the bond value of the float, right? Then if you have to value your fixed rate bond, if you have to do that, what do? Right? In a fixed rate bond, you have a standard fixed coupon bond with the same schedule as the swaps fixed leg. You discount each fixed coupon and final principal, right? The final principal which will come at the last at the OIS spot curve to find its present value. Ultimately, once you have done that, right? Swap value, what is the swap value in this case, right? Swap value is nothing but the difference, right? Value of swap is equal to your bond value in the floating case minus bond value in the fixed case, right? So if you are, let's say, paying floating and receiving fixed, means please understand this part also. Sometimes people get confused, which I think Anil was also asking. I'm just clarifying that. Please understand, if you are paying your floating, you are receiving your fixed, right? Means you are a floating payer, right? You're a fixed receiver, floating payer. Then positive swap value, right? Means we swap positive, means the fixed rate you logged in, right, is above their current market rate. That is why you are in positive now, because you are receiving fixed rate, right? So if you are getting more value, you are in positive value, means you logged in the higher rate, right? That's why you're in profit, right? Otherwise you would not have logged in the higher rate, right? In case, oppositely, in case in case if you are paying fixed and receiving floating, right? Receiving floating. Then what is the case there? Right? You are a fixed pair receiving floating, right? In that case, if you have a negative swap value, means value V swap is negative, right? Negative value, right? So it means that B float minus B fix is less than 0, right? Please understand that sometimes the question will come whether you have a positive value or negative value. You should be able to understand what your position was. You have a negative or whatever you're paying fixed or receiving floating. Whatever you're receiving, that has to be greater, right? If your receiving is greater, right, that means you're positive, right? Right. So it means when your negative values means your fixed rate payments are cheaper than market, right? Uh, if I have to calculate the numerical, now we can go back to the question which was there. Again, I have given you a lot of context, guys. I explained in long way a small thing. Why? Because this is, you might get confused when you go back and try to do it. So I've added that value that once you look at this, you are pretty sorted, right? Now we can go back to the presentation, right? Where you will get more idea when you solve the numerical, right? So if I go back to the presentation, so I've explained you with the logic. Now what is happening here, right? Same thing, right? You're talking about what? Same thing what I explained you earlier, right? You have a long FRN, you have a short fixed bond, right? If X has a long position in floating, right? You're buyer of a floating, pay, right? Long position, right? So means you're bought of a floating, so you're playing float, receiving fix, right? So if you are paying float, right? Right. We are trying to find out you are receiving fixed. You are trying to say that whether it's positive or not. If floating, or you can find out the value. Your long position in floating means you are paying float, right? That's what is happening. Now, in this case, let's say the notional principal. I'm taking notional principal is your 1 million, right? Swap fixed rate, right, is equal to 3.5% annually, and you have semi-annual coupon. Okay, and then let's keep it your time to maturity is 3 years, right? So if I have to find in this case fixed leg, right? So what is happening here? The point is that ultimately I am getting this coupon, right? I am getting this coupon, which is your 0.035% divided by 2 into your 10 raised to power 6. I am getting this coupon, right? This coupon has to be discounted, right? This coupon has to be discounted 5 times, and the 6th time you will get, in fact, 6 times you have to discount, right? You have to discount 6 times because the cash flow is coming 6 times, right? You are getting the coupon here, you're getting the coupon here, right? 0.5 year, 1 year, 1.5 year, 2 year, 2.5 year, right? And you are getting at 3 year, right? So coupon you are getting every year, right? 2.5 year and 3 year. your coupon, right? So you are getting this coupon there 6 times, right? So that you are getting. So you can calculate, right? You can discount it to find out your fixed leg, right? You can discount it. You have to take your whatever the rates which have been given. You discount it, right? You have this coupon coming every year, and the last one, this is 6 times coupons received 6 times, right? And last year you received the whole principal, right? Then you discount the whole principal. Every coupon you will receive, you will discount, guys. The discount rate is not given, so I'm not solving it, but all things have to be discounted back, right? Similarly, you calculate the floating leg also. So if the values are given, we are not doing it. The difference between that is the value which the value for your fixed rate receiver. Why this is value for the fixed rate receiver? Because you yourself see, right? This PV, right? Fixed leg PV, right? What is this fixed leg PV? Fixed leg PV means what? Right? Fixed leg PV is, tell me guys what it is. This is bond value of fix, right? This is floating value. This is bond value of floating, right? In this part, in this question, we are doing floating minus fixed, right? Why are we doing floating minus fixed? Because we are paying floating and receiving fixed, right? So the point here is that if you have a long position, right, you should long position in floating rate, right? So what is happening when you have bought a bond, right? You have bought a bond, you are paying, right? You are paying the floating, you are receiving fixed, right? So that's how it shapes up. And please understand this replication concept. Any OTC swap can be broken down into your cash, bonds, fixed and floating. You can calculate the valuation once you have bootstrapped the OIS discount curve and know the forward rate. You can find the present value of each bond, and it is very simple to calculate this way, right? It's very simple. Okay, keep that in mind. Okay, the next part, right? The next part which I'm trying to figure out, all right, which I want you to understand. Okay, just a second. All right. Okay, let's do the practice question, guys. This is very interesting. Let's do the practice question. How this is solved? How can we get the value in this case? This is exactly similar to the question you will get in exam, right? Exactly, uh, such kind of question comes in exam. You have given the notional principal, you have given the coupon semi-annual, you have given the maturity which is 18 months, right? You have been given your what you say spot SOFR rate, 6 month, 12 month, and 18 month to discount. The fixed rate is also given, right? And with coupons. Which of the following amount is closest to the value of the swap to the floating rate pair, guys? So, okay, what we can do is, because we have to write here a lot, right? We have to write here a lot. I don't think I will be able to complete this numerical here because these are long numericals. What we can do is, let me take a screenshot of it and take it to OneNote, right? Take it to OneNote, guys. I have to write it a lot here because these numericals are very long actually. Okay, so let's solve it in OneNote, right? Because there, if it is less to write, I can write here, but since it will require uh, too much to write, so what I'll do is I'll again switch to your OneNote, right? Again switch to your OneNote. right? Okay, your one note, right? That you can do, right? So if I switch to your okay, wait. Okay, so keep that in mind. Okay, let's solve it, guys. Let's solve it. All right. So you have this question, right? Again, identify your cash flow first, right? The first step is identification of your cash flows, right? You have what you say. You have a question where you have 18 months of maturity. Spot SOFR is given, right? What are you doing? Which of the following amount is closer to value of the swap to the floating rate pair, right? So we are talking about floating rate pair, right? So floating leg you pay, right? Floating leg, please understand, floating leg resets today to the current SOFR. Current SOFR, and by convention, at a reset date, its present value equals the notional length, right? So that's what you have. Now, what about your fixed leg? Fixed leg you receive, okay? So you receive how many? 18 months are there, na? You have 18 months. So the payment are every 6 monthly, right? So 18 months. So you receive basically three semi-annual payments. Three semi-annual payments. And since it is a fixed leg, the rates will not change. It is equal to your basically what? What is it? 2.8%, right? So 2.8% divided by 2 semi-annual, and you have 6 zeros, right? So your cash flow is 14,000. That's the cash flow which is coming, right? Now let's go to the SOFR curve, right? You have been given three things now. You have to next step is you build the discount factors, because you have to take the present value now. So when you have to build the discount factors, you see yourself that t is equal to 0.5, t is equal to 1.0 and 1.5. The spot rate given to you was your 2.6, 2.65, and 2.75, right? And then once you have the spot rates, the simple point here is that if I have to find the discount rate, right, discount factor, right, discount factor will come out as 1 divided by your 1 plus 0.026, the first one, right, 26 first rate, 2.6, right, into your zero point 0.5, because it is obviously 6 monthly, right? That is how you calculate, and it comes out at 0.9871, right? Similarly, when you calculate the next one also, it will be 1 divided by 1 plus next one, which is your 2.65, 0.0265 into your zero point 0.5. This will come out to 0.9742. And next one is 1 divided by 1 plus third one, 2.75, 0.0275 into your zero point 0.5 is equal to your 0.9591. So you got three discount factors, right? Now, once you have got the discount factors, your life becomes easy, because now you have to calculate the third step, which is calculate the present value of the fixed leg, right? Calculate the present value of the fixed leg. When I talk about calculating the present value of the fixed leg, present value of fixed, right? Ultimately, you have got multiple coupons, right? You have got multiple coupons at every stage, right? So what you have got? You have got your 14,000 coupon first year, first 6 months, right? You multiply with the discount factor 0.9871, right? Next is your again 14,000, which is multiplied by 0.9742, again 14,000, you multiply by 0.9591, and your last coupon, which is your 1 million, right? Last one will be your principal amount, which comes back. That will be multiplied by the last, which is 1.5 year, 0.9591, right? So if you see your, just time value of money, what is happening here is that you are getting basically 4 coupons, right? Your 18 month, 3 coupon. One is coming here, one is coming here, one is coming here, right? So basically, but now why I have taken 4 values? The point here is very simple, because here my discount factor was 0.9871, here was 0.9742, here was 0.9591, cash flow here was 14k, here was 14k, here was 100k, which like 1 million, which was coming, right? And your not 1000k, basically 1000k which was coming, plus 14k was all coming, right? So basically I have divided into 2 parts, right? 14k is going here, 1000k is going here, right? So these are giving 2 cash flow, rest are these cash flows, right? So I try to do it in a very simple way, right? Very simple way, and then we try to calculate the value of each, right? So the value comes out to be your 999, right? 985, right? If you solve, the total value comes out like this. Now this is your fixed rate calculation, guys. This is only the fixed rate calculation. Now you have to go to floating rate calculation, right? Then you go to your floating rate calculation, right? And you go to a floating rate calculation, right? What happens is that when you try to, it's reset, right? It resets, right? So present value of float at your n is always equal to resetting, right? Which is your 1 million, right? So if I have to find out, right? If I have to find out uh, the the kind of, what is the floating rate thing, right? If I have to find out what is the okay, the floating rate, right? But what will happen to the floating rate, guys? Tell me. So let's go to the slide. I think I have written enough. You can see the floating rate calculation there. So fixed rate, I have done it, guys. Floating rate, you can see there, because it will be easier to present there, right? So let's go back. Just a second. If I go back now here, see yourself. This part, okay, I think my calculation was not correct, right? The calculation will come out your 1,000,753. My calculation was wrong. Maybe something went wrong there, right? Maybe square or something went wrong. So you can look at this thing, right? You can check this calculation, guys. This calculation, check again, right? This calculation, check again. These cash flows were right. These cash flows were perfectly right, but I think discount factor calculation got some error, and I think that error is, I got it. That error is that it has to be 1, 2, and 3. It has to be this. I think the error I have understood. Okay, okay, whatever. Basically, I'm rubbing it and saying that put discount factors properly. Discount factors properly. So only thing was that exponential power is missing, guys. In my calculation, when I did the calculation, what was the mistake? The mistake was that I missed out on this part. 1 power, 2 power, 3 power. I missed out on this power. Rest I did same. I divided by 1.006 divided by 2, 1.0265 divided by 2, 1.207 divided by 2. I did same. The power 1, power 2, power 3 was missing. That's why the value came differently, right? We can go back to our OneNote again, right? I have corrected it. So just a second. The power was missing, so the numerical became wrong, but that's okay. We can correct it now. So the mistake was this, guys. I'm highlighting also. It's a good lesson. You don't do that mistake in a hurry. I did this mistake. Right? I missed out on 1, 2, 3. Right? That's fine, right? Once you have 1, 2, 3, then you put discount factors, right? I'm rubbing it. This part I'm rubbing it. Basically, put discount factor 1, 2, and 3, right? So here also I am rubbing it. Your discount factor, right? Discount factor, right? Which I'm trying to rub, right? So this was your discount factor 1. This was your discount factor 2. This was your discount factor 3. This was again discount factor 3. Right? You can combine it also. That's also fine. This was discount factor 1. This was discount factor 2. This was discount factor 3. And what was the calculation of discount factor where I went wrong? Here, 1, 2, 3. This will be discount factor 1. This will be discount factor 2. This will be discount factor 3. Right? The rest all is same, guys. This power got missing, so the value didn't come right. Right? The value is your 30, right, and 765, right? So basically this value was this value was this, difference is 765, right, plus 765. So answer to this question, if you go back, right, you go back, if you okay, if you go back, if you go back, 753, whatever. I'm saying 765, but it was 753, right? So go, you check it, guys. Basically, you check it. It's 753. Do the calculation yourself. Use the calculator. Answer is 753. Rest all part I have explained very clearly. This was the mistake which happened, which also I have given. Rest is quite simple. Okay. So this is done part. Let's go ahead, guys.
What is the floating part?
Floating part resets at everything, na? Every maturity it resets, na? So it will be 100,000 only, right? 1 million only. Every maturity, what happens in the floating, right? In floating part at every maturity, that's what is given in the slides also. You will go, right? We are at a semi-annual reset date. So the floating rate portion has a value equal to the notional amount at each your payment date, right? At each payment date, your floating is reset, right? Reset to notional. Right? Each is set to notional, right? Okay. That's why we have 753. Okay. Right. All right. Next part, guys. Again, a tricky thing. Again, I have to go to OneNote and teach you. Now we are doing what? See, we have seen the first part was your, first we did with your two bonds, right? FRN, your forward rate note, and your fixed rate bond. Now we are trying to value and interest rate swap with your FRA, right? With a fixed rate, a forward rate agreement, right? What do you mean by forward rate agreement? Right, I have discussed forward rate agreement earlier in the forward rate, that it's an agreement for the forward period, right? You are agreeing today that you will take a loan maybe after 3 months for 6 months, right? So forward rate, okay, what we can do again, I have to again, because these things need extensive notes, guys. So I have to go back to again OneNote, right, and write there, because in slide you will not be able to complete everything, right? So you go here, just remember this was 753, guys, right? This was 753. Okay, do the calculation yourself, you will get the answer. Okay, and also gives you a good idea. Don't do the mistake which I did in a hurry, right? 1, 2, 3, right? Don't miss out on this discounting. Basically, you remember now when you have to take out, you have to go back one time period, you take raised to power 1. When you have to go back 2 time period, you take raised to power 2. When you have to go back 3 time period, you have to raise to power 3, right? It's a stupid mistake which I did in a hurry, but that also gives you an idea that you guys should not do it, right? Okay. Next one, guys, again a very
In the Sudhanshu,
yeah,
one more question. In
yeah,
the question that we did, if you go to the question,
yeah.
I mean, how we will come to know that this is following the bond method only?
No, no. So you don't have to think about that. Ultimately, see, the cash flows are given. Nah. See, it doesn't matter for me. It's what method is following. Ultimately, I have the cash flow. My focus is on the cash flows, right?
Hmm.
I have the cash flows that okay, my 14,000 cash flow, which is coming fixed. I have a floating leg and a fixed leg. My focus is on two legs, right? In the fixed leg, I got 14,000 cash flows. Ultimately, I have to discount it, and in the floating leg, I have 100,000. So ultimately, whenever you are solving swap, it doesn't matter whether you think about your bonds at turn on. Your focus should only be between floating cash flows and fixed cash flows, right? Whatever cash
Okay.
flows you are getting, you should discount it and see the value, right? Ultimately, it's the difference in present value of difference of cash flows, right? Or you can say present value of cash flows, present value of floating minus present value of fixed,
Hmm.
right? So my thing here is you don't have to think about bond etc here. That was just a theoretical concept, but ultimately I saw when I saw this thing, right? I saw that rates are given to me, coupon is given to me, coupon gives me cash flows, right? 2.8% I multiplied, I got a cash flow of 14,000, right? So 14,000 cash flow was coming here, 14k was coming here, 14k was coming here 14k was also coming, and principal also was coming 100,000k, right? So I was like, okay, let me discount it, and that's why I found the discount factor. That's simple. I found the discount factor floating. I don't need to any do. It is currently the floating reset date. If it is a reset date, I don't have to do anything. If it's a reset date, means it
Oh,
is
okay.
right,
Assuming that it is currently the
right,
floating reset date. Okay.
right. So it is 6, right? It is 1 million, right? Floating reset date, it is 1 million, right? So I this part is I don't need. If it is not a floating reset date, then I have to do the calculation there also,
Ah, okay.
right?
So I
Then I
am
have to do
getting
the
confused there only that why we have not performed the floating rate
yeah,
calculation.
yeah, yeah.
Okay.
I'm not doing the floating rate calculation because it's a floating reset date, right? If they have given no,
All
it's
right.
a floating
Understood.
reset day is different, then I have to do calculation there also.
For floating as well. Then we will
Yeah, yeah.
take the SOFR and then we will discount the SOFR with the OIS curve and then we'll
No.
multiply with the notional.
So basically, let's take that example also hypothetically. If
Hmm.
I if your if it is not a floating reset date,
Hmm.
right? It is not a floating reset date, right? If it is that kind of scenario that it is not a floating reset date, then we have to do two things, right? Basically, then we will not have so many cash flows. We will have one cash flow which is on the maturity, which is your this 1 million, and we will have one cash flow which is which is the whatever is the floating rate, right? Whichever will multiply,
6 months.
because what is happening, you are getting a cash flow here, it is getting reset, right? Then you are going from here to here, right? Once you reach here, again reset. Once you go from here to again reset. So my botheration is only between last reset date and today's place. So if it is here, I am calculating only the interest part of this portion, right? You're getting my point,
Correct.
right? So I am see if you have to go, let me depict it more, right? Basically, please understand that floating rate. Basically, what happens in floating rate is, if you think about it, your basically if your let's say interest is like this, it goes down zero, right, again comes up, right? So it is like this, right? Right, it is like this, or whatever, it is coming down with time, right? So, but the point which I'm trying to say is that every reset date, right? Every reset date, when you 1, 2, and 3, every reset date, it will become, your interest component will become 0. Let's say it's not a floating reset date, it is like here, right? Between here, 15 months, right? Then I am only bothered about interest component from 12 months to 15 months, because 12 months it was reset. So my value is only from here to here, right? For only 3 months. So I will calculate the coupon only for 3 months, guys, and I will add whatever interest I earn. So I'll calculate the 3 months cash flow here, 3 months cash flow, and then I will kind of discount, right? And I will add into this. That's it, guys. I don't need to have, in floating, I don't need to take 3, 4 cash flows. I don't need. I only will have one, this cash flow, which is the flow, which is the reset amount, and whatever is the interest which I'll earn, this minor interest which I'll earn in the medium part if it is not reset. Okay. So in floating reset date, there will only be 2 cash flows. Got the idea?
So in this example, there are 3 SOFR rates given: 6 month, 12 month,
Yeah.
and 18 month.
In that case, they will give us one more SFR rate at 15 months.
And they will say that 15 month is the reset date.
No, they will not say. They will say that 18 months is the reset date, but the time passed is only 15 months. Means you have to calculate this interest component for 15 months, and the value which you will get here, you have to discount it to 12 months.
Okay. So we will not calculate for 6 month and 12 month.
No, we will not calculate for that.
Because we are assuming that 6 month it's a reset, and
12 months
then 12 month also it's a reset.
Reset, right? It's a reset happening.
So nothing would be calculated. We will just calculate 3 month interest rate. We will discount that with the SOFR.
SOFR of that month, that 15 months, whatever is given.
And we'll add that to
we'll add it to your principal
notional.
amount.
Notional.
That's it.
Then you'll see the 18th month, whatever our current note.
18th month we cannot do it. 18th month is reset again. We don't have any interest component.
Till 15 only we'll close. We'll complete up to 15 months, then we'll close it. That's it.
No, if it is given reset, if it is 18 months and reset is also 18, we'll not calculate any interest component.
Okay, I understood the calculation. Now, what is the logic of this reset? I'm like, in actual world.
See, this is how it works, right? This is the floating. Basically, that's the beauty of the floating rate, right? Floating rate, anything in the floating rate loan, right? It always kind of resets, right? It always, that is because every 6 months, if the interest rate increases, let's say it goes to 8%, right? 7 to 8%, right? So it resets. It not necessarily that this will remain same. Basically, if it is, let's say 6 months to 1 year, the interest rate changes. Earlier it was, let's say 7%. Now at 12 months it will be 8%, right? So reset is like every 6 months you will check with the benchmark and you will reset to the benchmark.
Fine, that I understood. Now my question was more from the valuation point of view. When I am saying floating reset, then what the counterparty will receive from that perspective, from the valuation perspective, I was thinking. Because if we are resetting, that means I am not getting any interest component here, right? So then what is the benefit of the counterparty? Why?
Okay, so you are asking that if in a floating bond, there is a floating reset which is happening at every semi-annual, every 6 months. What is the benefit to the counterparty in that case? Because that counterparty is not earning any interest because there is a floating reset which is happening, right?
Floating reset happening, yes, correct.
Right. Okay. See, let me answer in a different way, right? See, the point here to understand is that these are what do you say, kind of properties, right? These are when you talk about your resetting of the in the rates or you are talking about reset of the the valuation of the bond, right? Especially in the floating rate bond, right? Why this is the phenomena which is followed in the world, right? The logic of this phenomena to be followed in the world is because there is absolutely, first of all, a demand for this product, because anybody who is trying to hinge himself to the benchmark, right? So let's say you are doing a coupon reset, right? Your next coupon cash flow is set with the benchmark, right? Just after the coupon is reset, a par kind of thing will come, right? So there is a zero net carry, no interest rate, right? Now, why the world likes it? Because there is a consistency with the benchmark. There is a simplicity in hedging. There is risk management, which is working very fine, right? There are broader implications for your swaps FRAs, right? Since if you have a par trade that reset, right? Replication of a floating leg with an FRN is kind of exact, right? So the reset at par convention for your floating rate instrument is not just a what you say accounting trick. It reflects the very much a fundamental economics that coupon always reflects your current funding cost and eliminates any kind of your interest rate risk at each reset and creates a very transparent hedgeable market kind of thing, right? Now, adding on to this, what your question is that what about the counterparty, right? How is the counterparty affected? Because if everything is being reset, counterparty is not getting anything, right? Now, coming to that part, see, the point here is that when you're talking about that counterparty is not getting anything, it's not like that, right? See, the point is that counterparty, when counterparty is entering in such kind of situation, counterparty is very well aware that this is how it works, right? Just after reset, when both legs present values are equal, so the net kind of value of the floating rate is kind of zero, right? But since the issuer has committed to pay the future floating rate coupon and holder has also kind of agreed to receive it, right, which is the future cash flow, right? So in a swap, the floating cash flow is exactly offset by the opposite party's fixed cash flow, right? So whenever you have for a counterparty, if I have to give it a very simple terms, uh, they do get something, right? The obligation to pay the floating coupon is real value, right? In a swap, when you have a reset, right? Reset or every reset only zeros the floating leg present value. The fixed leg present value remains, and that's where your counterparty gains, because between resets, both sides trade on kind of exposure between those legs. But at the end, right? Uh, the what you say, the interest, every reset the interest is kind of exchanged, right? And since interest is exchanged, so the counterparty is as such gaining, right? So what is happening is that in this case, the reset which is happening, right, in this part reset, where is the interest rate going? Interest is being
Correct.
paid na, right? Every time it is being paid na in the interest, right? You're getting my point. Every reset the interest is paid, right? So it is not that the interest is just evaporating. It's not like that, na. Interest is not
Okay.
evaporating. It is interest which is paid to the counterparty at every reset. Make sense
Yeah,
or
it
not?
makes sense. Yeah, it made sense. But then for the calculation perspective, when we are calculating, uh, floating minus fixed, right? What you
Hmm.
mentioned here is that we will only take the 3 month interest rate, right? Because the reset, the interest component, we are not discounting it, right?
Because we are
And
trying
now
we are
you
trying
said
to
that,
find we are trying to find the present value now, but the interest is only earned for that 3 months now, because last interest is already paid, right? 12 months the interest is already paid, 6 months the interest is already paid. So the only interest which is not paid is between the 3 months which is not paid now. My
Oh,
objective is
okay.
to equate the present value of cash flow. Na? That is the only part which is not paid. Na?
Okay, okay. Understood.
Okay.
Understood.
It's
Fine.
typical,
So
this is,
every reset,
yeah,
every reset, we are kind of understanding that it would be paid in the upcoming cycle. So for that perspective, we are taking the discounting factor of those period and we are ignoring the past dates.
right, right. Right.
Hmm.
Okay.
Okay.
All right. We were doing the next part, but it's okay. Right. So this we have done it. We've gone this. We are doing the question number 4. Okay, we have to do question number 4. I have to copy paste it. Mm, I think I had already copy pasted. No, no. This is 3. Let me go to slide. Just a second. This is a very what you say, not an easy topic to understand, guys. This is, you have to be at your toes to understand, right? And I think this is the last numerical which is kind of difficult. After that things are easy, right? This is, I mean, last value of interest rate with FRAs. Thereafter it is, there is nothing there in the topic, right? So we'll finish by 10 o'clock, right? All right. So, coming back to, valuing and your, what you say, interest rate swap, right? Valuing and interest rate swap with now FRAs, right? FRAs, right? Forward rate agreement, right? You're trying to value an, you know, FRA, right? With your valuing an interest rate swap with an FRA, right? So we are trying to do that, right? FRA, I have already explained you, right? It's a forward rate agreement, right? What you need to understand more is that forward rate agreement, in that sense that you kind of agree that, okay, I'll take a loan for, let's say, 3 months, right? After 3 months, right? So what you do in a FRA, okay, let me write it down. Basically, just very simple, right? FRA is a forward rate agreement. So you say when my FRA is 3 into 6, right? Right. So what it means, that I am taking a loan after 3 months for 6 months, right? Or for 6 months. This is 3 month loan, right? This I have explained you in your interest rate topic also. I have told very clearly that, I will take a loan after 3 months for next 3 months. So this is the first time period, this is the last time period. So you can take the difference, you find out this is a 3 months loan he has taken, right? So that is what you need to keep in mind, right? Secondly, please understand swaps, right? Swaps are also called as your series of your FRA, right? This is a general definition. The swaps are also known as your series of forward rate agreement. So you can apply the same principle. You can calculate the forward rate for each period. You can use your expected cash flows and discount at your spot rates, right? And ultimately, you'll find the present value of floating, present value of fixed, and you find the value of the swap in the same way, right? Same kind of question. Again, you will do present value of floating, present value of fixed, and you will find out. Plus, please make sure that you have to, in the floating, you have to kind of again take your cash flows and discount at the SOFR. In fixed, you have to take the fixed rate, right? You have to understand that we are using forward rate agreements. We'll solve a numerical. I think I thought this was numerical given, but it's not a numerical given. It's just a general discussion. So we can go back to slides, and the next numerical which is coming, we will solve it here, right? All right. Okay, not given, so you can practice there. Next part is valuation of your interest rate swap, right? We have done. Now we are moving to currency swap, valuing currency swap with two bonds position, valuing currency swap with a sequence of FX rate, swap credit risk, and additional swaps we'll talk about, right? Currency swaps, very simple. Generally, guys, interest rate swap comes in exam. Currency swap does not come in exam, but still, we have to see it, right? We have to try to solve it. When we talk about your currency swaps, please understand that currencies are being exchanged, right? Currencies are being exchanged, and there is no netting of payment, right? Most important point here is that there is no netting of payment which is happening, right? There is no netting of payment which was happening in your interest rate swap, right? Here, there is no netting of payment happening, right? So if nothing, no netting payment happening, and principal is exchanged at inception also and maturity also, right? So there are two things which are happening which are very different: exchange of interest and principal in different currencies, spot rate used at inception, no netting of payments, right? There are some things which are very different, right? So when you look at your structure and cash flows, your currency swaps are very different from your interest rate swaps. Two currencies, two streams. You have your principal also, you have interest also. Let's say there is a party A which borrows your USD and party B which borrows your GBP, right? In the spot market, they agree to swap both your principal and the interest payment, right? So at inception, right? Right? A delivers USD, right? And your B delivers, right? Right? A delivers your USD, right? Right? And what happens with B, right? B delivers GBP, right? So we have at the inception itself, there is an exchange of the currencies, right? Then what happens during the life of the swap? A pays B a certain fixed rate, B pays A certain fixed rate. At maturity, they kind of re-exchange their principal at the same initial notionals. No netting is done across currencies. You use the spot rate which is given at the inception. So the question also comes that, sir, why do we exchange principal? See, exchange of principal is needing because of your hedging funding needs. Each party effectively locks in your borrowing in the other currency without going to the market, right? Now when you do that, you eliminate FX risk on your notional by swapping back the original principals. Neither side faces a final FX translation gain, which you have learned in your FX chapter, right? Or loss at maturity, right? So how do we do such kind of thing? You please remember that ultimately when you have to solve such kind of question, you have to understand that you have to kind of uh, wherever you're trying to find the value of the swap, you have to take the present value of a leg, and you have to take the converted pay leg, right? So what I'm trying to tell you here is, this part is the present value of USD, right? Present value of USD fixed. This part is a converted pay leg, right? Converted pay leg, right? So your this part, right? B pays in USD. So PV USD, which is fixed, right? This is the present value of, right? This is the present value of B's fixed USD coupons. Present value of B's fixed USD coupons plus return of your notional USD. Okay, at maturity, and everything discounted. This present value, everything discounted at your USD OIS, your LIBOR curve, right? So again, tricky, not easy. We'll solve a numerical, then you will realize such kind of questions rarely come in exam, because this chapter is very difficult, guys. This chapter is not easy. Again, same thing I told you earlier also. You'll take the present value of inflows, foreign bond, minus present value of outflows, which is domestic bond. USD bond present value is given. GBP bond present value converted is given, which I told you converted pay value, and then you got the value of the swap. We'll see a numerical whether we have it or not. Okay, let's try to do this, guys, and let's try to do this in a very simple way, right? Suppose there is a company X which pays 5% annually in euros to company Y and receives, right? So what we are doing here is, please understand, you are paying a company 5% annually in euros to company Y and receive 4% annually in dollar, right? So paying in euros, receiving in dollars, right? Company X pays the principal amount of 150 million to Y. Y pays 100 million pound to X. Inception of the swap. Assume the yield curve is flat. Okay, in the US and Germany, so there's no change of interest rate. US interest rate is 3%. Germany is 5%. The current spot rate exchange is 1.45. What is the value of the currency swap to currency X using the bond methodology if it is expected to last for 2 more years? Very simple, guys. In fact, best way to do is to see the solution, because you will realize that we'll waste lot of time. If you see the solution, it will happen very fast, because it's not a bigger solution, right? See here. That's why I brought you here. See yourself. What is happening here? You are taking bond value for your dollar. In dollar, you found out the coupon. You go back, you found out the coupon. Coupon was 6%. Right? You see yourself that when you went here, right? Okay, 4%, right? 150 was the 150 million into 4%, right? So 150 into 4% is 6, right? So please understand, when you try to find out the coupon, right? You have 150 million, you multiply with 4%, you got 6. You have 150 million dollars, you have 100 million euros, you multiply with your what? 5%, right? Which is the initial one, right? You got 5%, you got 5 million. Only difference is this is dollar, right? Dollar 6 million. This is your euro 5 million. So these are your coupons, guys. These are your coupons. Now let's go ahead again. So, right. So these are your coupons. So you see yourself one coupon, right? You see yourself here. One coupon is 6. One coupon is 5. Then they are discounted by their respective rates. 1.03, 1.05. Then what you have done is you are just taking the final value. 156, right? 105, right? And you are finding the value. Right. What I'm trying to say to you is, right? What I'm trying to say here to you is that $6 million comes here, 106 comes here. Similarly, for this part, right? Your 5 million euro comes here, euro, and 105 comes here, right? Thereafter, it is all discounting, right? 6 is discounted at 3%, right? This you will discount at 3%. This you will discount at your 5%. That's it, guys. That's it. You are discounting, right? So you have seen two cash flows, and then you discount it, right? You discount this part, you discount this part. Once you discount it, you get it, right? You get it. So you got 152.86 and 100, right? That you got. But some noise is coming, guys. Some noise is coming. Let me mute it. Okay, fine. So the point which I'm trying to tell you here is that it is very simple, guys. You found out the coupon 6. The principal amount also comes back, the second year, 106. You found out the coupon which comes after 1 year. You found out the principal coupon which comes out second year. You discount it. This is to be discounted 3%. This is discounted 5%. Only trick here is that you found out that it's 152.86, right? This is the dollar value. Now, right, you will have to convert this 100 million euros. You have to convert into your dollars only. Either you convert both to dollars, either you convert both to pounds, right? That is the case. You convert this into your dollars. The dollar conversion is 1.45, right? So conversion was what? 1 euro was given as $1.45, right? So this was given, so you converted it, right? So what I'm trying to say here is that question looks very difficult. Please understand, it's all about finding the coupons and then discounting it and finding the value. And ultimately, once you have converted into pound or ultimately you have got the final thing, please don't forget to again convert one of the currencies, either both into pound or both into dollar. You convert and you get the answer.
I have a question here.
Go on.
Why is always I mean the discounting is always discrete. It's just okay if I do the compounding continuously, because I see that it's not continual compounding.
No, it's not continuous. It is discrete.
Why? I mean, what's the, because I thought that that should be normally continual.
You can use continuous also. There's
Ah,
nothing
okay,
wrong.
okay,
So
okay. I see.
your answer will not differ much. Instead of
Okay,
7.86, it will be 7.89 or 88, right? That much.
all right.
So you will still reach the same value in this question.
Sure.
You
Thanks.
can use continuous also.
Okay, yeah.
Okay. No
Because
worries.
the previous example, actually, I got the same question by the previous example. I mean, because
Okay.
I thought I was thinking that, yeah. Okay,
Yeah,
that's fine.
you can use. There's no
Okay.
problem, right? Right. This
Mm.
step is very important, guys. Please remember to convert it into back to your currency. Otherwise, it's not difficult. Just remember it to convert, right? So it creates a confusion, but remember it. Okay. This is done, guys. I think we are almost at the end of the chapter. Um, this is done. Currencies. Okay, valuing currency swap with a sequence of FX rate, right? What is this, guys? Basically, your book wants to talk about that. You know, when you're trying to value,
Sudhanshu,
yeah, go on.
if you go back to the previous question,
Right. Tell me.
oh, the question, please.
Okay.
So it's 150 million, right?
$150 multiplied by 4% in dollar, right?
So one is 4%, one is okay. And if you go back to the calculation again, what is this 106?
106. Which one? 106.
The first, yeah, you've written 106, 3%, and then
No, no. It
106,
is 156. 156.
156. Okay. That's
156.
fine.
Right.
That's fine. That's
Right.
fine.
And 156. 156.
Because
Okay.
150 and then the 6, 156.
Yeah.
Okay,
Yeah.
yeah, fine.
Okay. All right, guys. Next part is some discussion about valuing currency swap with a sequence of FX rate. Basically, what is the discussion here? What your book wants to talk about is that you know they want you to understand that you have to have separate pure FX risk from your interest rate risk, right? You have to use your consistency. You have to use your kind of interest rate parity. So no arbitrage exists between your FX forwards and the interest rate differential, and you can kind of stack your FX forward, right? So basically, what is happening here is that you are you have two legs in your different currencies, right? You have two legs in different currencies. One is your fixed leg and one is your floating. And whether you are in FX, you are in USD or Euro, whatever, right? You receive one, you pay another. You can convert your flows, uh, you know, single currency USD flows. You can take that in Euro and convert into forward also, right? So the point here which I discussed is that if you are looking for a, let's say, logical flow, right? uh, okay, and if you are looking at your simplistic understanding, right? The point here is that whenever you are uh, you can use, right, you can use your forward FX rate and discount rate, right? And that can help you kind of uh, calculate, right? That can help you calculate your FX swap, right? Uh, you can use it for fix currency swap, right? You can use to convert one currency to another, right? And you derive your FX forwards. You build using your FX forward your another currency's cash flows, right? So the whole point here is, right, even though numerical will never come from here, right, because this is very complex, right? Ultimately the point which you're right, the point which you want to make, right, the book wants to tell you that you can use your forward FX rate, right? Till now you have been using your spot FX, right? You have been using spot FX rate. The point here is that when you are trying to value a swap, right, you can also use, right, you can also derive FX forward, right? So if I have to write down the crux of this whole thing, what they want to explain is that whenever we are trying to find value for fix currency swap, right, you first of all define the legs, right, for different currencies, USD and everything, right? Then what you do is you gather your spot FX, right, and your fixed rates, okay? Then you derive FX forwards, okay? And finally you project your cash flows, right, and then you convert and discount, okay? So objective of this discussion, no numerical will come. They just want to tell you that you can also value currency swap with a sequence of FX rate, right? You can also use your FX forward, right? You can calculate the expected FX adjusted cash flow, right? And you can use interest rate parity to drive FX forward rates. No need to do it, guys. This is just theory, right? Basically, at the end of valuation of your swaps, they want to tell you that there is not, you don't have to follow one single path, right? You can follow a different path also. You can gather your spot FX, right, and fixed rates, right, and you can use it to derive your FX forward, right, your foreign currency forwards. Till now you were using spots. What they're telling you, you can derive FX forward, you can project your cash flows, right, and you can convert and discount and find the value, right? Again, I'm telling you, a lot of you would get confused that why this is being introduced. Do I have to solve numerical? No, just theory. They are just ending the numerical part saying that please don't think that if you have to calculate your numerical part, you have to only follow one method. There are other methods also. You can do it by your FX forward, and that can be done. You can calculate the FX forward using your spot forward. FX forward using your spot rates. And once you gather your spot FX and fixed rate, you can derive your FX forward, and that can help you to project your cash flows. And then you can kind of discount those cash flows and convert and discount it, right? So only theory, guys, only theory. No numerical will come from here. It is just an additional value they want to talk about, right? Then we talk about your swap credit risk, guys. Obviously, when a swap is there is a credit risk. One side will gain, one side will lose, right? What is the one side gain, other side loss? That's a default risk. As swap value increases for one party, counterparty risk increases because the party can default. Potential losses are generally your less than your debt instrument due to limited notional exposure, because you're not, the full exposure of notional principal is not there, especially when you're talking about your any interest rate swaps or everything, it's only the difference which we traded. So less potential losses due to limited notional exposure, right? Additional swaps which we have in a syllabus are equity swap, commodity swap, credit default swap, volatility swap, exotic swap. Equity swaps are exchange of your index return versus fixed and floating, right? So you might say that, okay, I want to exchange the return on Nifty index versus, let's say, some fixed interest rate or floating. Commodity swap, you fix price for energy and resource like natural gas with the crude oil. CDS credit default swap is like an insurance you buy, which happened in 2007-9 financial crisis. Also, companies bought your insurance, and which happens with any instrument. Like people buy your insurance against any default, right? Credit protection, payment upon default. The company which is selling insurance will pay. It's like a buying of insurance. Then you have volatility swap. Volatility swap is the difference between swap on realized versus implied volatility. In options, you have seen already that when you talk about options, right, there is a realized volatility, there is implied volatility. When you can have a swap on that, very structured product kind of thing. Exotic swap is a complex combination. Okay. Which type of swap is most likely to be considered the most complicated terms in terms of structure, guys? Commodity swap, credit default swap, exotic, and volatility. I think exotic will be the answer, right? Yeah, exotic, right? Exotic is the answer. So that's it, guys. That's it from my side for today. But I know this topic is very, very complex, guys. My suggestion to every one of you here is, see, two questions will come from here. I'm telling you right now itself. Two questions will come from this chapter. Only two questions. One will be calculation of your valuation for interest rate swap. We have done the numerical for fixed versus floating, floating versus fixed. And one question will come on currency swap.